What you need to know about IRAs: a guide to individual retirement accounts. Millions of Americans depend on individual retirement accounts, more commonly called IRAs, to help save for the future, i.e. retirement. More than 40% of U.S. households reported owning some type of IRA, according to research from the Investment Company Institute, ICI. IRAs can help you save for retirement without the help of an employer plan. Let's unpack some of the most popular options. Traditional IRA. Established in 1974, Congress designed traditional IRAs to give people not covered by retirement plans or pensions at work a tax-advantaged savings plan, notes ICI. They were also designed to be a vehicle where employees who left a job could roll over funds from a 401k retirement plan into the IRA. With a traditional IRA, there are no income limits. In most cases, contributions are tax-deductible. The money you invest grows tax-deferred. Then, you'll pay taxes on the money when you withdraw in retirement. Tax deduction phase out. The tax deduction on your contributions begins to phase out with a modified adjusted gross income, MAGI, of $73,000 for single filers and $116,000 for joint filers. That means if you make more than that, you may be unable to take the full tax deduction. And if you make more than $83,000 for singles and $136,000 for joint filers*, you can't take a deduction. People in higher tax brackets sometimes choose a traditional IRA if they think they'll be in a lower tax bracket when they retire. Roth IRA. This is often the first choice for many savers because even though you contribute to a Roth, you don't receive a tax deduction, but the money grows tax-free and withdrawals are tax-free. Depending on how you're invested, and how the market performs, your money has the potential to grow exponentially, which can represent a huge tax boon. Roth eligible contributions. To be eligible to make the maximum contribution to the Roth IRA, your modified adjusted gross income, MAGI, as a single tax filer can be no more than $138,000*. For joint filers it's $218,000. At that point, you can make a partial contribution until you hit an adjusted gross income of $153,000* for singles, and $228,000* for joint filers, at which point the right to contribute phases out entirely. Spousal IRA. What if you're married and not earning an income? If you have an income-earning spouse, and file joint tax returns, you can contribute to retirement, in your name, using what's called a spousal IRA. Here's the deal: the working spouse contributes on behalf of the spouse who isn't earning income. The limits on contribution and income are the same as they are for traditional and Roth IRAs. And, if you're self-employed. For small business owners or self-employed, there are two IRAs to consider. Simple IRA. This stands for Savings Incentive Match Plan for employees. Is designed for small companies, those with 100 employees or less. It allows employers to contribute dollar-for-dollar matches for contributions of up to 3% of employee pay. Simple IRA contributions. Employees can't contribute as much as they can to 401ks, but more than they can into traditional or Roth IRAs. For 2024, employee contributions cap out at $16,000, and $19,500 for employees 50 or over. SEP IRA. SEP IRA has significantly higher contribution limits. They're best for those who want to contribute for themselves and perhaps for a spouse, but not necessarily for employees. Based on the 2023-2024 tax year, this article is for educational purposes only and is not to be used as investment guidance or advice. For financial and tax advice for your situation, consult a financial or tax advisor. For current tax information, visit irs.gov. We really appreciate your time. If you like the video, don't forget to hit the like button and subscribe.